Hello everyone, I'm Justin Bender, Portfolio Manager at PWL Capital in Toronto and creator of the Canadian Portfolio Manager blog. In the last 3 installments of my Understanding ETF series, we toured the developed markets equity ETF landscape. Of course, when it comes to investing, you don't have to limit yourself to developed countries. As you can see in this world view, there's a lot of turf to be covered by venturing into the blue-colored emerging or developing markets. Today we'll explore how to further diversify your portfolio by adding ETFs that invest in emerging stock markets around the globe. In 2003, BlackRock released the Ishares Msci Emerging Markets ETF, EEM. Msci is an acronym for Morgan Stanley Capital International. EEM tracks the performance of over 1,000 large and mid-sized companies located in 24 emerging countries around the world. The BRICS countries, Brazil, Russia, India, China, and South Africa, make up about 57% of the fund's total country allocation. As EEM trades in US dollars on the US Stock Exchange, Canadian investors may find it more convenient to purchase the Ishares Msci Emerging Markets Index ETF, XEM, instead. XEM follows the same index but trades in Canadian dollars on the Canadian Stock Exchange. However, its cost is relatively high at 0.82% per year. Investors may be better off purchasing the BMO Msci Emerging Markets Index ETF, ZEM, which also trades on the Canadian Stock Exchange in Canadian dollars but has an annual cost of just 0.27%. ZEM holds about 85% of its stocks directly, making its structure slightly more tax efficient than XEM. Each company in the MSCI Emerging Markets Index is weighted according to its float-adjusted market capitalization. For more information on float-adjusted market caps, please watch my video Understanding Canadian Equity ETFs. In 2011, BlackRock also launched the Ishares Msci Emerging Markets Small Cap ETF, EEMS. EEMS complements EEM by following the MSCI Emerging Markets Small Cap Index, which tracks the performance of over 1,500 smaller companies located in the emerging economies. By allocating about 89% of your emerging markets equity investment dollars to EEM and the remaining 11% to EEMS, you gain float-adjusted market cap exposure to most emerging market stocks at an annual MER of about 0.69%. As you may have already pieced together, there's also a single index that follows a combination of the MSCI Emerging Markets Index and the MSCI Emerging Markets Small Cap Index. It's called the MSCI Emerging Markets IMI Index. IMI stands for Investable Market Index, which includes large, mid-sized, and small-sized companies. This index follows the performance of over 2,700 emerging companies, providing broad stock market exposure. As you might expect from my previous videos, there are yet again ETFs available that track this more diversified index. The iShares Core MSCI Emerging Markets ETF, IEMG, trades on the US Stock Exchange in US dollars. IEMG tracks over 2,700 emerging market stocks and has a cost of 0.14% per year. In addition, its sister ETF, the iShares Core MSCI Emerging Markets IMI Index ETF, XEC, trades on the Canadian Stock Exchange in Canadian dollars. XEC has an MER of 0.26% and simply invests in its US-listed counterpart ETF, IEMG, to gain exposure to emerging market stocks. This wrap structure makes XEC less tax efficient than IEMG when held in a tax-deferred account, such as an RSP, LIRA, RIF, or LIF. The extra tax drag is due to the additional 15% US withholding taxes that apply on foreign dividends paid to Canadian investors from the underlying US fund. For more information on foreign withholding taxes, please refer to our white paper on this subject, but here's a quick overview of their expected impact. In 2005, Vanguard US released the Vanguard FTSE Emerging Markets ETF, VWO. VWO follows the FTSE Emerging Markets All-Cap China A Inclusion Index, which tracks the performance of over 4,000 companies located in 23 emerging countries around the globe. This makes it similar to IEMG. As discussed in earlier installments, FTSE stands for Financial Times Stock Exchange, and All-Cap indicates that the index tracks large, mid-cap, and small-cap companies. Before you get too excited about the 4,000 plus holdings in VWO, know that over 1,000 of these holdings are small-cap China A shares, which currently account for less than 1% of the fund. I'll discuss China A shares in more detail in an upcoming video. In 2011, Vanguard Canada launched a Canadian version of VWO, the Vanguard FTSE Emerging Markets All-Cap Index ETF, VEE. VEE has an MER of 0.24% and simply invests in its US-listed counterpart, VWO, to gain exposure to emerging market stocks. This wrap structure makes VEE less tax efficient than VWO when held in a tax-deferred account, such as an RSP, LIRA, RIF, or LIF. There are a number of notable differences between the MSCI and FTSE Emerging Markets indices. Plus, the country classifications are in a constant state of flux. It's probably best to consider emerging market investing as an even more inexact science than usual. At least at the moment, here are some of the variations on the theme. MSCI classifies Korea as an emerging market, so includes about 422 Korean companies in the MSCI Emerging Markets IMI Index. As you'll recall from my last video, FTSE classifies Korea as a developed country, and therefore includes about 418 Korean companies in the FTSE Developed All Cap ex North America Index instead. MSCI classifies Poland as an emerging market, so includes about 37 Polish companies in the MSCI Emerging Markets IMI Index. FTSE classifies Poland as a developed market, so includes about 37 Polish companies in its FTSE Developed All Cap ex North America Index. MSCI classifies Kuwait as a frontier market, so excludes it from both its developed and emerging markets indices. FTSE considers Kuwait to be an emerging market, so includes about 13 companies of Kuwait in its FTSE Emerging Markets All Cap China A Inclusion Index. Both MSCI and FTSE include a portion of China A shares within their emerging markets indices. However, MSCI currently only includes about 234 large-cap China A share companies, while FTSE includes about 1,915 large, mid, and small-cap China A share companies. As shown in this chart, IEMG and XCC each currently allocate about 14% of their holdings to Korean stocks, while in turn underweighting many of their other top country holdings relative to VWO and VEE. Even with this relatively large difference in country holdings, the ETF's underlying indices have had similar performance between 2006 and 2018. This may not be the case going forward, but during this period, the FTSE Emerging Markets All-Cap ex-China A Inclusion Index returned 6.4% in Canadian dollars on an annualized basis, while the MSCI Emerging Markets IMI Index returned 6.2%. We're getting close, but we're not yet done with our ETF World Tour. Now that you have a number of international and emerging markets equity ETFs to choose from, I'll show you in my next video how to properly combine them so you're neither excluding Korea from your portfolio nor unintentionally overweighting it.